Safe haven assets. Where the rich invest their money. When the sea is rough, captains steer their ships towards safe ports, i.e., areas of calm and perceived safety. Similarly, investors seek investments that maintain or increase their value when markets are turbulent like the current ones. Such asset classes are known as safe havens. Dear viewers, if you appreciate the video and want to help us grow, we ask you to consider the idea of subscribing to our channel and making a donation to support us. Your support is essential for us and will allow us to continue creating interesting and useful content for you. You can do it here below, through the appropriate buttons, subscribe, and thanks. Market downturns are inevitable and are part of the normal market cycle. As investors, we need to be as prepared as possible. It is necessary to find a way to evacuate your funds into safe havens until the storm subsides. Safe havens can help investors reduce the risk of losses during market downturns. If they can identify assets that are most likely to increase their value or maintain it when other assets are falling, they can prepare for market movements. However, there is no guarantee that what served as a safe haven during a market downturn will be equally safe during the next downturn. Investors should therefore carefully evaluate their options before choosing a safe haven asset. How do you know if an asset is a safe haven? The safety of an asset in times of economic instability is evaluated based on, among other criteria, its correlation with conventional assets. This section provides an overview of safe haven assets. Let's look at the characteristics of safe haven assets. The appeal of an asset as a safe haven is based on the following characteristics. It is a safe haven asset that is not subject to the same market conditions as other assets. In other words, they have the potential to be valued in the event of a market crash. 2. Liquidity. The asset must be easily convertible into cash at any time. This allows you to enter and exit positions at their price and avoid slippage. Slippage is the difference between the expected price of a trade and the price at which it is actually executed. 3. Supply and demand. The supply of safe assets must be limited. There must also be constant demand to keep the price stable. If the supply of an asset exceeds its demand, the asset tends to lose value. An excellent example of this type of asset is gold, which is scarce. When demand increases, the value of gold grows. 4. Permanence. An asset must not deteriorate or lose its intrinsic value over time. Additionally, it must not be too expensive to maintain. 5. Functionality. The asset must not be easily replaceable in the long term. The asset must provide a function that can support demand in the long term. Types of safe havens. When looking for safe havens, always keep in mind that you are not buying to make a lot on the investment. Rather, it is about buying assets that retain their value and reduce your exposure in the event of a significant and prolonged market downturn. Here are some of the most common ones and how they can help protect your capital during periods of instability and uncertainty. 1. Liquidity. It has been said that liquidity is the true safe haven when markets are down. Make sure you know exactly how much cash is worth and what it can buy. The main advantage of cash investments is liquidity, which can be used immediately to meet immediate obligations. However, returns are negligible, and if inflation is taken into account, cash investments are constantly depreciating. 2. Currencies. Historically, the currencies that investors seek safety in during difficult times are the Japanese yen, the Swiss franc, and the US dollar. For example, the Japanese yen often appreciates against the US dollar when US stocks and bonds are volatile. It is therefore considered a safe haven. After World War II, the Japanese economy recovered quite quickly and caught up with the rest of the world. The respected Bank of Japan has worked hard to establish the yen as one of the major world currencies. Despite occasional government interventions, the yen remained attractive to investors during the financial crisis due to its liquidity. The reputation of the yen as a safe haven is largely due to Japan's trade surplus relative to its debt. In other words, the value of foreign assets held by Japanese investors is much higher than the value of Japanese assets held by foreign investors. Therefore, when markets are in a risk-off phase, funds tend to flow back into the Japanese market from other currencies, strengthening the yen. And since everyone believes that the yen is a safe haven, the yen continues to strengthen. It is a self-fulfilling prophecy, so to speak. The Swiss franc. The Swiss franc is known to appreciate against the yen when global markets become unstable. This fact was confirmed by a detailed study by the Deutsche Bundesbank, the German central bank. The Swiss franc has earned a reputation as a safe haven currency due to the renowned political neutrality of the Swiss government, a progressive and stable banking sector, and a solid economy. Furthermore, Switzerland's independence from the European Union makes it immune to negative economic and political events that could shake the region. This makes it a popular destination for capital flight during financial crises. US dollar. Investors have always considered the US dollar as a safe haven. This is due to its liquidity. In fact, the US dollar is the most liquid currency in the foreign exchange market, which makes it, among other things, the most important safe haven. The US dollar earned its reputation as the world's primary reserve currency with the Bretton Woods Agreements of 1944. Even after the abolition of this system, the US dollar was still considered a safe haven, as it represented the world's largest economy. Although the policies of the current US president have been controversial and volatility has increased, the reputation of the dollar has not suffered as analysts expected. The US dollar index rose 5.29% between January and August 2018, even though stock and commodity markets experienced fluctuations due to increasing trade tensions. 3. Government bonds are fixed maturity debt instruments issued by governments to meet expenses and other obligations. They pay regular interest to investors and are considered low risk because they are backed by the state. Bonds issued by developed countries are more appealing. U.S. Treasuries are therefore the most popular and are backed by the full faith and credit of the U.S. government. Like cash, government bonds have low yields and some even negative ones. 4. Gold. Historically, gold has always been considered a safe haven. The price of gold is not subject to the decisions of national governments' central banks, and its supply cannot be controlled by printing, as is the case with currencies. Gold has maintained its value for a long time and has been used as insurance against adverse economic events. In the event of a prolonged period of unfavorable economic events, investors move their money into gold, and the price rises. For example, during the 2008 financial crisis, investors sought refuge in gold. As a result, the price of gold increased by 24% in 2009 and continued to rise until 2011. Gold is relatively liquid, and unlike other precious metals, it can be easily converted into cash. On the other hand, gold does not offer a return and is expensive to store. 5. Defensive stocks. Defensive stocks are shares of companies that provide essential goods and services, such as utilities, healthcare, consumer goods, food, and beverages. They are considered safe assets because their products are constantly in demand regardless of economic conditions. Furthermore, during recessions, defensive sector companies tend to perform better, as investor demand for their shares increases. In conclusion, safe haven assets offer security during recessions. It is necessary to understand the pros and cons of each asset considered as a safe haven and which asset is best to use in particular circumstances. A safe haven in times of market volatility may behave differently in another recession. Therefore, the only consistent safe haven is a diversified portfolio. For this reason, caution is advised when seeking investment destinations that can serve as safe havens. It should also be considered that safe havens during an economic crisis do not always perform well when markets recover. In the comments, share your direct experience related to the topic covered today. We want to learn more and will gladly respond to any questions. Comment to let us know how we can improve. Your like would make us happy. Do not forget to subscribe to the channel so you don't miss the next video.